Thank you for standing by, and welcome to the Northern Star June 2020 quarter results conference call. All participants are in a listen-only mode. There will be a presentation followed by a question and answer session. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Mr. Bill Beament, Executive Chair. Please go ahead.
Good morning, everyone, and thanks for joining us. On the call with me today are our Chief Executive Officer, Stuart Tonkin, our CFO, Ryan Gurner, and our Chief Geological Officer, Mike Moroney. Today's results are a testament to the underlying strength of our business. They demonstrate that, to a large extent, we have managed to weather the COVID storm and generate record underlying free cash flow. Strong production and robust margins at all our operations drove the solid result. That said, the measures we put in place early on to help protect our people against COVID clearly took their toll on our performance in the past 2 quarters. The impact was particularly pronounced at Pogo, where we safely and effectively managed 36 cases of the virus in the June quarter. This had a direct impact on labour availability. We simply had fewer people, which translates into lower operating physicals. This was all the more disappointing given that during the quarter we finished the transition to long-hole open stoping. The benefits of this new mining method can be seen in the ore tonnage, grades, ounces, costs and free cash flow generation. But all these metrics would clearly have been better had our workforce not been limited by the virus. The reality is that as long as the virus is prevalent in Alaska, our volumes at Pogo will be reduced, probably to the tune of around 25%. That said, these results also show that our strategy for Pogo is working and that the mine will deliver the tonnages, grades and production we envisaged at the time of acquisition. It is a Tier 1 asset in a Tier 1 location, and the results will reflect that once we emerge from the COVID fog. Our results over the past 2 quarters have also been restricted to a degree by our decision to reduce our hedge book. We sold 170,000 ounces into hedges, or approximately 34% of our production over the past 6 months, reducing our margins somewhat in the process. We expect to continue this strategy in the current half as we seek to increase our exposure to the significantly higher spot gold price, both Australia and US. The reality is that a significant portion of ASX-listed gold production is not selling for anything like the current spot price. Northern Star is already one of the lowest hedged ASX gold producers. Our hedge book now represents only 15% of our forecast production over the next 3 years. But while we are decreasing our hedge positions, we are also strengthening our balance sheet. Earlier this month, we repaid the 200 million Australian of debt we drew down at the start of the pandemic, and we are now in a net cash position. To cap things off, we also bought back early the payment of our interim dividend totalling $55 million. Our CEO, Stuart Tonkin, will now give us a rundown on the operations during the quarter.
Thanks, Bill. We are very pleased to end the financial year with such a strong quarter 4 and set up FY21 for further growth and strong cash flow generation from a very solid platform. Pogo operation in Alaska delivered a strong performance of 50,000 ounces sold despite the constraints imposed due to the impact of COVID. It is a credit to the operational team on site to increase the control measures and contain as best as possible those 36 active COVID cases during the quarter. And I'd like to thank them for their exceptional effort in managing through this and continuing to do so. The operation maintained development rates at 1,200 metres a month across priority areas to access new stoping fronts, and we're focusing on 3 of the 5 main stoping zones. The total ore tonnes achieved an average of 68,000 tonnes per month at an impressive grade of 8.4 grams per tonne, showing the strength of the mineralised system consistent with our models. Our present COVID measures relate to an impact of roughly 25% reduction in mining physicals, as Bill stated, as we reallocate teams in response to isolated personnel. Until we are COVID-free, throughout the state and the operation, this is the likely average run rate per quarter and will be reflected in upcoming guidance for Pogo given the reality of the prevalence of COVID in the state of Alaska. Despite this setback, our team remain dedicated to modify and adapt to the landscape, and we are generating strong US dollar cash flow from Pogo, even at these lower operating volumes. This gives us great comfort of the growth potential of Pogo and the fundamentals of this Tier 1 asset. We will continue to build contingency to mitigate COVID impact to these operations. To the Jundee operations, the June quarter capped a very strong year with 78,000 ounces sold at 1,078 all-in sustaining costs, taking the full year to a 300,000 ounce produced operation. Underground production improved 10% from the March quarter, with 584,000 total ore tonnes at 4.5 grams produced. This equates to an underground mining rate of 2.34 million tonnes per annum. Also during the quarter, our projects team successfully completed and commissioned the new 4.5 megawatt ball mill, taking the installed mill capacity from 2.2 to 2.7 million tonnes per annum to accommodate various open pit sources to complement the underground feed. Ramone open pit mining continued during the quarter, and planning works associated with the Julius pit advanced during the quarter. Contained gold in stockpiles at Jundee increased by 49,000 ounces over the year, with 84,000 ounces in stockpiles at the end of the June quarter. And our regional project evaluation continued on the southern Yandal tenements to advance the organic growth opportunity from the Bronzewing region. To our Kalgoorlie operations, we delivered it as expected, with improved mining volumes by 13% from the March quarter at 850,000 tonnes. We also increased milling 10% from the March quarter to 974,000 tonnes at 3 grams per tonne, utilising stockpiles from throughout the year. Our costs in Kalgoorlie do remain high due to the lower grade material averaged across the mines, but Kalgoorlie operations continues to generate strong cash flow and has significant leverage to the gold price that we are experiencing at present. Kalgoorlie Ops sold 79,000 ounces at all-in sustaining cost of 1,615 Aussie dollars in the June quarter, delivering a full year result of 317,000 ounces sold. And our contained gold in stockpiles at the end of the June quarter totaled 26,000 ounces. Now to KCGM, where with our JV partner, we are making strong progress in liberating the opportunities of this impressive asset. As demonstrated by an increase in material moved by 43% from the March quarter, there is a hive of activity across the three main pit zones of Golden Pike, Morrisons and Brown Hill. We are utilising the idle fleet, and we remain on a recruitment drive to encourage existing and new Kalgoorlie residents to join the KCGM team on this long life asset. It's a good way to spend your job seeker dollars is relocate to Kalgoorlie and apply for a job at KCGM. Underground mining physicals at Mount Charlotte increased 25% from the March quarter, and milling throughput increased 7% from the March quarter, demonstrating the significant efforts of the KCGM team and the acceptance of new ownership there. We look forward to providing greater insights into this asset in the coming quarter in concert with our JV partner. Northern Star's share of contained gold in stockpiles at KCGM were greater than 1.5 million ounces, underpinning a significant contingency and de-risked asset for the company. With that, I'd like to thank you, our shareholders, for your support through a challenging period. We are well positioned with our Tier 1 portfolio to deliver continued organic growth and continued superior financial returns for many years to come. I would now like to hand to Ryan for the financials.
Yeah, cheers, Stu. Good morning, all. I'll go through now some of the key financial aspects of the June quarterly results. Starting with the cash flow waterfall charts on page 5, which show an overview of cash bullion and investment movements, which at 30 June stand at an impressive 770 million, up 18 million from March. Record production and sales during the June quarter generated 332 million in operating cash flow, up 80% from March quarter, and 218 million in underlying free cash flow, both records for the company. This underlying free cash flow was generated after investing approximately $44 million into organic growth across exploration to set up future production areas and expansionary capital to increase production. As a result of the outstanding June quarter performance, at year end, a key milestone was reached, with the company being net cash positive, with cash and bullion at 748 million and corporate bank debt of 700 million, a fantastic achievement only 6 months following the transformational acquisition of KCGM. And as Bill mentioned, on the back of this exceptional performance, we repaid $200 million of that debt and brought forward our interim dividend early in July. During the June quarter, the Australian operations sold just over 212,000 ounces at an all-in sustaining cost per ounce of $1,360, taking full-year performance to 727,000 ounces sold at $1,350 per ounce. Both Jundee and Kalgoorlie operations had a great quarter to end the financial year, recording increases across all production metrics and realising reductions in cash and all-in sustaining unit cost metrics. Pogo now, where after a challenging June quarter, our team demonstrated their resilience with 50,000 ounces sold at an all-in sustaining cost of US $12.76 per ounce, taking the full year result to 173 ounces sold at $14.02 US per ounce. With spot US gold prices at $18.70 per ounce, Pogo's cash generation is expected to grow. We're also seeing our procurement initiatives realised, with Pogo's total site costs, excluding exploration investment, the plant expansion costs and our corporate allocation averaging $20.5 million US per month over the June quarter, which is down approximately $1.5 million per month from the March quarter. Pogo did incur some additional operational costs from COVID-19 relating to employee benefits, some personal transport and accommodation, freight and cleaning. These costs are reflected in all-in sustaining metrics. KCGM had another solid quarter with pre-tax free cash flow contribution of $47 million for the June quarter, with 56,000 ounces sold at all-in sustaining cost per ounce of $1,400. Full year results under Northern Star's ownership were 116,000 ounces sold at $1,427 per ounce and pre-tax cash flow contribution of 88 million. One matter to highlight is Northern Star's all-in sustaining costs presented for KCGM are different to our JV partner. This is primarily due to Northern Star using sold ounces as a basis for calculating all-in sustaining metrics and, of course, differences in corporate cost allocation to the operation. Finally, in respect to the company's hedge commitments, we have and will continue to accelerate delivery of ounces from our book, consistent with our strategy to increase our future spot price exposure. No additional hedging commitments were executed during the June quarter, and at 30 June, the company's hedge commitments stand at 536,000 ounces at $2,085 per ounce, which approximately equates to 15% of annualised production over the next 3 years. Mike, over to you now for exploration.
Thanks, Ryan, and good morning, everybody. Group in-mine exploration drilling activity was maintained across the Australian operations, with a reduction in Pogo's in-mine drilling activity reflecting the impact of COVID-19 related travel restrictions. The in-mine exploration largely concentrated within existing mine corridors and continued to generate consistently good results, particularly at Jundee and Kanowna Belle. At Pogo, while underground drilling focused on infill and definition programs to support the production activities, excellent intersections were recorded from numerous unmodelled structures, particularly in the Lisi LQ area, Lisi 2 and North Zones. Our regional activity was restricted during the quarter. However, considerable work continued on the integration and evaluation of the recent Echo Resources acquisition into the regional exploration portfolio. Looking forward, Northern Star's planned FY21 exploration program will continue our strong commitment to reinvest into the organic growth opportunities contained within the group's existing asset portfolio. An extensive program of in-mine and regional exploration activity is underway across all areas to expand Northern Star's resource and reserve inventory. For example, at Jundee, we'll move into the second year of a 14-rig underground drilling campaign to build on the resource and reserve growth success achieved in the past year. Total in-mine drilling is forecast to increase by approximately 25% to approximately 440,000 metres across the year. In addition, work is commenced on resource definition and exploration programs across the broader Yandal region, encompassing the recently acquired Echo Resources assets. In Kalgoorlie, the underground and surface exploration programs will build on the recent success within the upper levels of the Kanowna Belle mine and the adjacent environs, the continued growth of the resources in the Carbine area, and the long-term exploration of the large South Kalgoorlie exploration portfolio. At Pogo, in addition to the in-mine exploration expansion program, a significant investment will be made into the first stage of resource definition drilling into the core of the Goodpaster area, where initial exploration drilling has outlined a 2.5 kilometre long mineralised corridor. The benefit of this sustained exploration investment into our operational centres will be reflected in Northern Star's annual resource and reserve update, which will be released in the next few weeks. I will now return the call to the moderator for questions.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you are on a speakerphone, please pick up the handset to ask your question. Your first question comes from Sophie Spartalis from Bank of America. Please go ahead.
Good morning, team. Just a couple of questions. Firstly, Kalgoorlie. Stu, can you just talk through the path forward to lowering costs? I know it's obviously due to these lower grades, but sort of how long do these lower grades hang around for?
Look, it's pretty average at that 3, so that's pretty much going to be the story going forward there, Sophie. So, yeah, we see accelerated or increased unit all-in sustaining costs because it's the same amount of work for a bit of less contained metal. But there's a number of other initiatives that we're doing across the site to try and find some productivity gains and some absolute cost outs. That grade drop is really driven by the removal of the rally higher grade ore that we put on pause back in the quarter.
Okay, can you just maybe go through some of those initiatives and sort of the quantum of cost outs we can expect, and therefore where that potential new normal could be for Kalgoorlie all-in sustaining costs?
Look, we produced at 16, just a bit over 1,600 all-in sustaining Aussie. There's probably $100 to $200 an ounce that you can work on. We've got, obviously, with KCGM, we've got some more buying power in the region. We're looking at the procurement ability and some synergies across those things. But at this stage, that's the challenge with the site. But they're already doing an enormous job on a lot of the productivities in development. It's really around looking at the production side of the activities.
Okay, so that was my follow-up question. So just in terms of the regional potential coming through, is there any high-grade satellite pits that you think you could bring on over the next few years to assist with bringing down those costs?
It's not necessarily high grade, but potentially lower mining costs with those satellite pits. So Carbine, Paradigm region, lower grade but lower mining costs. So they're the type of opportunities with a blended feed that could bring the unit costs down.
Yeah, so okay. Bill, quarter 4 is a very good indication of the Kalgoorlie operations. As we said earlier on, it's not the highest grade, but its leverage to the gold price is extreme. There's a lot of gold there. It's running at the cost structure it is, but it makes huge free cash flow generation. So it's a great benefactor to the company's overall group cash flow.
Okay, sure. Thanks, Bill. And Ryan, a question on hedges. Obviously, you're trying to continue to accelerate the closing out of the hedges, but the Aussie gold price is still looking quite high. You didn't commit in the June quarter. Is there an expectation that you'll maintain that, that 15% average annualised rate sort of in a rolling 3-year fashion? So can we expect you to be adding to those hedges to take advantage of the higher gold prices in the coming quarters?
Look, Sophie, we talk and look at these things all the time. We restructured our book, so we've got no absolute commitment this next half. But as we've demonstrated and have illustrated that we are wanting to bring them back, so we've got absolute discretion. I think we look at as a percentage, between 20 and 30%, probably of our book that or our sales that we'd like hedged. So that's what we're sort of working on basically.
Yeah, so Sophie, we obviously took on some hedging with the KCGM transaction, which probably put us at the top end of our policy. We're probably just getting our book more back into the bottom end of our policy. And also we have used put options, which is something that's been fantastic. We've made a lot of money out of put options with not committing to hedges, obviously cheap insurance policies. So expect us to probably use that as well behind the scenes, as they're very cheap at the moment with what you can lock in from a put as an insurance policy.
Okay, thank you. And just a final question from me, just in terms of Pogo, understand and appreciate the huge challenging conditions that you've got over there with COVID. The reduced operating rate, how long do you anticipate that for? Like, I know you said until you're COVID-free, or is that until we get a vaccine? Like, so can you maybe just elaborate on potential timing there, just for modelling purposes? Is it sort of 12 to 18 months?
Look, who knows, but I think we're also we're not sitting still on those actions, so there's still a lot of things we're doing to build contingency into that. I think the first half of our financial year will maintain to be disrupted at that rate. But, for every one case, you kind of knock out three, sort of a 1 to 3 isolated staff. But what's happening in the state, we're getting better testing regimes, greater visibility, quicker turnaround of those tests. So we're basically putting everyone through on a weekly basis those tests. So our guidance will reflect what that is, but we expect to be able to, as demonstrated, operate through experiencing cases and a great outcome that the site's getting better and better at managing it. And pleasing for us is that the effect of the health on our staff and their quick recovery and returning to operations has been positive too. So I think in the health and the demographic of our staff, I think it's a quick recovery.
Okay.
Even at these lower levels, though, you can see with the US gold price and the US cost base, $1,200 and $1,800, it's still generating significant US dollar cash flow from Pogo. So, I think even if it was extended in this impact, it's still a very, very profitable operation. Okay.
Is there an opportunity to accelerate or bring forward any desktop work that's needed, and therefore we could see positive surprises out of the situation at Pogo?
Look, the plans are there. It's really about the people on the seats, and I guess there are fixed constraints at the site. Drilling wise, that'll be probably the news flow. You're bringing a lot more drill rigs back and getting. We basically put our efforts into the production drilling, not necessarily resource reserve expansion, because we've already got a good visibility of base there. They're the type of things that'll feed through. As Mike illustrated, we'll be putting efforts into the good pasta in the coming 12 months to drill that out. So potentially news flow from Pogo expansion of resource base is on over the next couple of years.
Okay, that's great. I'll leave it there. Thanks.
Thank you. Your next question comes from Daniel Morgan from UBS. Please go ahead.
Hi, Bill, Stuart and team. Just firstly on the Super Pit, just want to know, how you're thinking about it over the next couple of quarters. It appears in the last quarter that you're really hammering the material movements, dealing with the waste. Obviously, the productivity there was a lot higher. Is that what we can expect in the near term, that you're going to focus on getting rid of that waste rather than gold? Thank you.
Look, thanks. Good question, Dan. No, look, it's between the JV partners and us, we're accelerating. We're opening up that flexibility as we articulate the last couple of quarters. We want to have multiple mining fronts, so we are moving that material to achieve that. And the team on site with the fleet that they've got are doing an extraordinary job, so expect that to continue. We will give a lot more colour and clarity on KCGM later on this quarter with our JV partner, but expect the next couple of quarters and beyond a little bit like that. We've got some great opportunities to open up all those multiple mining fronts, so expect material movement will be higher this financial year.
Okay, thank you. And just on Pogo, I guess I've been impressed and surprised at how the production has been in spite of the challenges. I mean, obviously they were massive challenges during the quarter on COVID. I'm just wondering, in simple terms, if you have the same quarter, the same disruption, can you achieve what you've achieved this quarter, or did you consume a little bit of the investments you've made? I'm just trying to work out if we have the same over the next quarter or so. Is this what we should expect from this operation while you're doing these challenges, or could it be a little bit softer?
Yeah, so look, the revised strategy is, deal with what we've got. You saw an increase in development metres quarter on quarter, so we we slightly lifted that up to 1,200 metres a month, but we've always articulated we want to get 1,500 metres a month to get 5 main production stoping areas online. So we just had to triage and prioritise 3 of those 5 areas to get the efforts put into those. As things pick up, we can slowly open up more areas. So yeah, you've pointed it out that the quality of the ore that's coming out is adequate. It's really a volume game from here. Just to reflect on when we experienced these cases, it was predominantly in the operating teams in the underground. So you can potentially knock out your whole crew for days. It's not evenly spread across milling and mining and your admin and those type of things. So it's very hard to model risk. So I guess what we're saying is, despite having those cases and the adaptation that we did, we truly realised a sort of 20-25% reduction in the volumes, and it might mean 100% reduction for days and then back to normal. And it's just hard to model that going forward. So the 45 to 50,000 ounces per quarter is likely where we can deliver under the current disruption.
Thank you very much.
Thank you. Your next question comes from Nick Herbert from Credit Suisse. Please go ahead.
Oh, thanks. Good morning, gents. Might just start on Pogo as well, please. Appreciate all the uncertainty there on COVID. And just thinking sort of beyond COVID, with all your operating experience there now, once you get a clear run at it, how long do you think it could take you to ramp up to that 1,500 metres per month rate? And does that 1,500, does that get you 1.5 million tonnes per annum through the mill?
So the 1,500 metres a month is really setting up those new stoping areas, and our expanded mill, our footings are going down for our filter presses and things that are for the mill expansion. So that's still going down in the summer season at the minute, and that's in play to take us from the 1 to 1.3 million tonnes per annum. And so if you sort of look at our total ore tonnes, 68,000 tonnes a month, we obviously want to get that above 100,000 tonnes a month. Of which you'll have sort of 60-65% from stopes and the balance from development ore. So the lead indicator is development, capital development, then the operating development that converts into long hole stoping. We're just saying 3 of the 5 active areas because we're prioritising. We know we can literally do those physicals when we have the people there, and we've shown instantaneous run rates with the team that's there. But the ability to get expats out of Australia and to do long rosters. We've had Australians that have sat there for 5 months continuously without seeing their families. We've had the lower 48 state staff commit and move to Alaska to limit the being locked in for entering the state. So there's been a bit of fatigue and a bit of logistics, but we're also looking at parallel contingencies to address that. So yeah, the tap could be turned on hard and we could get those physicals. It's really just whilst the environment is there, we're having to put all those preventative actions in place.
Thanks, yeah, that's really helpful. Just to clarify one point there, so the mill expansion work that you've got through COVID, sort of when's your sort of best estimate in terms of when that work would be complete?
If you look at the quarter, we produced at 200,000 tonnes, so we're producing at we're mining at about 800,000 tonnes a year run rate from the quarter under these disrupted circumstances, right? So with the expansion, that takes us up to the 1 to 1.3 million tonnes, and we're still likely, 12 months off needing that expanded mill, but we committed early to commit to that capital to get the works done in the right season, so you're not dealing with it at minus 40 degrees, so it's ready so that we're not mill constrained when the mining physicals are there.
Got it, thanks. And then just one sort of more broadly at the group level, appreciate you haven't given guidance for next year, but just trying to get sort of a sense of what a sustainable level of growth, capex and exploration spend is per annum that would sit outside your all-in sustaining cost. Should we take the year just gone as a guide, sort of a sustainable go-forward rate, or is it sort of above or below that?
Nick, we'll give guidance in the coming weeks as we put it quarterly, so all that will be clearly articulated and mapped out in a couple of weeks' time.
Okay, sure. Thanks.
Thank you. Your next question comes from Levi Spry from JPM. Please go ahead.
G'day, guys. Thanks for the call. Maybe just to follow up on Nick's question. I know you are giving guidance in a couple of weeks, but you have given us a data point of 15% of your hedge book being 15% of production, so inferring 1.2 million ounces for the next couple of years, 3 years. Can you just talk to what assumption is in that on Pogo? Is it business as usual?
Look, as I said, mate, we'll clearly articulate that in a couple of weeks' time, and the other thing we'll articulate is our organic production growth, which we're very excited about. So all that will be in there, and clearly articulated CapEx exploration and our forecast production moving forward.
There's a delay to get to that rate, Levi. So this impact in Pogo and the updated guidance will show a ramp to that, not a step change.
Yep. Yeah, Roger. Thanks, guys.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. Your next question comes from Keith Good from Eagle Research Advisory. Please go ahead.
Thanks. Oh, hi, Bill. I've just got a two-part question. Do you intend to recommission, firstly, Paulsens, and secondly, the Brunswick plant? Thank you.
Yeah, thanks, Keith. Good questions. Look, Paulsens, we're still doing the numbers. We went in there and did some drilling during the previous financial year, so that's come up pretty good. So we're just reassessing that mine plan. We'll explore options on that. It's probably not the size and scale for a Northern Star, but it's a great little project there. So as you would have seen, we divested our Ashburton project, so some of the smaller stuff we'll definitely look at corporate options. From the Brunswick side, like in a couple of weeks' time, we'll clearly articulate what we do there. But we're very excited what the Yandal operations look like. Jundee and Brunswick put the brother and sister back in the same family again. We're really excited about that, so we'll clearly articulate our strategy on that. I think Mike already said in his spiel that we've committed large funds to basically grade control and infill drill the current reserves and resources there, so we expect to generate a mine plan on that in the coming 12 months. So we still haven't made a decision of refurbing that plan or not, or we look at potentially expanding Jundee again. So there's a few options on the table, but we are committing to the Julius pit, and we're currently undertaking all the permitting of that side of things right now. So that is something that we will dig up, and I think we have expenditure in the budget to start digging that up later on this financial year.
Thanks very much.
Thank you. Your next question comes from Stuart McKinnon from the West Australian. Please go ahead.
G'day, guys. I just wanted to follow up with you, Bill, some comments you made back in April, talking about the potential mental health impact of the longer rosters and the increased social distancing on site. You mentioned then that, the whole industry had to be on red alert for mental health issues among its staff. I was just wondering, since then, have you seen sort of any deterioration among your staff? Have you seen that problem get worse, or are they holding up pretty well? What are your thoughts sort of 3 months down the track since you first made those comments?
Yeah, look, it was a real issue, and we did see significant spikes with our EAP providers. It has been. It was in the heat of battle. It was definitely a massive issue. Obviously, the industry returning back to normal rosters has greatly improved that. And obviously back in WA, we're very lucky that we're pretty much all back to normal in society, and so that's gone a long way for everyone. Doesn't matter what industry you're in, but I'm sure everyone's mental health is a lot better than what it was in March. So. Look, we've got great support systems inside our organisation, and I think the industry has. So, it's nowhere near as elevated what it was, but there was all the same challenges you were hearing about throughout the community. It didn't matter what sector, domestic violence, all those sort of things were elevated, but, I think we're returning and have returned in probably the last 5 to 6 weeks back to sort of as normalised as possible.
Right. Thanks, Bill. Cheers.
Thank you. Your next question comes from Matthew Friedman from Goldman Sachs. Please go ahead.
Sure, thanks. Morning, gents. Just a quick one from me on Pogo and the rate of development and sustaining capex spend. You've obviously been making that investment to, build up the buffer of development ahead of production and open up all those spaces. Just wondering whether that the current spend rate, all things considered with COVID, et cetera, is how we should be thinking about it going forward into FY21. Whether you feel like there's now enough of a buffer built up, or there's still an investment to make in that area. Thanks.
It's probably steady state, Matt, for the current physicals. We still, like all our other operations, probably like to get ahead. Builds contingency in the mine plan gives you optionality. So as far as the sustaining expenditure, if I could get 1,700 metres at Pogo and have all those developed tonnes sitting there, it's like having our gold in stockpiles on the surface. It's a de-risked mine plan. So yeah, we'll put that in, we'll include that in the guidance, but we never hold our teams back and say you can only get so many metres. We try to give them as much clear highway as we can to get in front with our mine plan. So it is a bit of a balance there, and obviously that reflects back into when you're building a new mine, that sustaining capex is lifting your instantaneous or sustaining cost, separated to a growth capital investment.
Yep, that makes sense. Thanks, Stu.
Thank you. I'll now hand back to Mr. Beament for closing remarks.
We have been positioning our business for this gold price environment for over 3 years now. We are focused on long life assets in Tier 1 locations with strong potential to generate organic growth for our shareholders. This is the formula which underpins our superior financial returns. COVID is obviously leaving its mark on our performance in Alaska, but the impact would be far more severe if we're operating in some other corners of the globe. It's one of the several factors which justifies our strategy of focusing only on Tier 1 locations. As I said earlier, we've reduced our hedge book so we can capitalise on this opportunity. Our strategy at Pogo is proceeding to plan, and we'll continue to see the benefits of that as our workforce returns to normal, COVID permitting. And we have significant medium and long-term growth prospects within our portfolio. We will have more to say on this when we release our FY21 guidance, reserves, resources, and our exciting organic growth update in a couple of weeks' time, as well as a full update on KCGM later in the September quarter. Thanks for joining us.